All right, welcome to the weekly meeting, October 7th, 2023. Okay, going to these weekly order blocks, I think GA is probably EA. EuroCAD is a bullish joint. I think we'll push up, pull down. EA, bullish order block, we need to push up, pull down. We talked about these EA, GA, EN, GN last week. When we look at the monthly candle, we know it needs to push up to that 62.78 area before it starts selling. So if you've taken any of these trades, these order blocks are kind of playing out in your favor. This one kind of worries me. EN, maybe it's just going to push down instead of pushing up. It looks like it ran out of gas, but you have good price action on the weekly. Maybe the 2 week can push up to about 177.89, but I was expecting this thing to get all the way to the zone. So if you're in those trades, in my opinion, there are better options. In my opinion, the better options are GA and EA, because you actually have order blocks. This is a bullish order block on GA. I know I have a couple of arrows here because I was actually in this. The trade has pushed up quite nicely. It's rejecting, so I believe we'll pull back down. Here's our zone. Here's the 78 area. There's an imbalance in this area, which is cool. So I'm looking for us to push down and then get it started going the proper way. So those are some of the trades I want to, I like the opportunities on the euro dollar. I like the opportunities on the British pound dollar. And, I like the fact that the dollar index is finally turning and burning. So if you look at this down move, obviously it's going to be about 12 weeks of straight push down. We broke the swing low, broke this low, we broke this low. So now we can get a retracement. So if you fib the move from here to here, your zone is going to be around the 1.08. Your 78 is right here at the weekly imbalance, which makes perfect sense. And that's about around $1.11, I believe. So you have a lot of room to push up before I believe we will eventually sell back down. And if you're a fan of a pattern, you can have your little head and shoulders pattern. Shoulder, head, shoulder, down. And I think that's pretty much how it's going to end up shaping up. So this is EU. GU is going to be the same. There are plenty of trading opportunities. And we'll let somebody break a trade down for us towards the end. But I wanted to get back to the fundamental conversation. And, it's funny because OG shared this video, this David Lynn video. I saw the same video. And in the video, he's asking this trader basically for what the trader thinks. And a lot of what this trader is saying is kind of the same, it's along the same lines of the way that we've been looking at the market. With the caveat, he talks about the 10-year T notes. And it kind of dawned on me, during this conversation that most of us in this group won't be able to follow the the references to the treasury notes. We don't understand the significance of what high treasury notes mean, and we don't understand what interest rates are. But if we're going to play this as a long-term game, I think we have to have a better understanding of how all of this stuff relates to each other. And he's going to talk about Canada and the how, like he's Canadian, but he's going to talk about how most people in Canada finance their homes with like a 3 to 5 year interest rate, and then they have to redo it. Who would ever do that? Like, why would you ever go short term like that? To me, it just doesn't make any. It's not good sense, because 5 years from now, the interest rates could be sky high. So why would anybody use a flexible interest rate, especially after 2008? But then I got to thinking about it. I'm like, well, nobody understands that stuff. Nobody understands how it all works. And I get that understanding because I'm a part of this group. And some of the questions that we face on a week-to-week basis allows me to know that, hey, man, people just don't get it. People don't understand the significance of some of the things that are happening, and people don't understand how it really affects their pockets. So
look at the play though. Look, we're gonna give you free healthcare. Oh, okay, this was a great government. We're gonna just do what they want us to do.
yeah, and it just doesn't make any sense. I mean, who would ever do that? And I guess the answer is a whole country full of people, because
A lot of people. A
that's
lot of people. I was in mortgage for 11 years, and you'll be surprised what people do just to get their payment low for 1 or 2 years. And then I see mortgages where their interest rates would go up to 17 to 25%.
and nobody can.
Oh yeah, you ain't lying because I'm
In the
in
UK,
finance
it's the
right now.
same as well.
But you got to understand too, man. Like when you're a part of a system and you're sold a dream, like, oh, you can go buy this house.
I can't buy that lie, Will.
But I know you can't, but you got to understand. That's what people deal with.
But no,
They'd rather go spend $3,500 on a mortgage as opposed to their $1,200 rent and still have to pay taxes and insurance. And then when they can't pay their tax and insurance, they still lose their home.
yeah, but how is that a good deal? This is what I'm
It's
asking.
not a good deal, but it's
I
about
know. So why would any
status.
sane person sign their name to that?
Man, it's the dream they sell. Go buy you a house and the white picket fence. I mean,
I can't blame that on a dream, though. Like to me,
I mean, I get it what you're
that's
saying,
ignorant.
but it's
But
not
look,
logical.
but look at our leadership. Look at our leadership. That's the examples we get. How do you not have people doing these things? Because that's the narrative they present, that this is what it looks like to be successful.
Well, but listen, y'all. So according to what y'all are telling me, if on the news at 6 o'clock they show a line of people lining up and jumping off the San Francisco Bridge, that means all week we'll have a steady line of people flying in just to jump off that bridge behind them.
Man,
That's what you're telling me.
Man, you're right.
I don't care how they glorify it, how they do the body paint, make them all pretty, find women jumping off the bridge. You know what I'm saying? I'm not going to jump off that bridge.
Man, dude, they trying to sell in Georgia. They trying to sell container homes for $300,000. A container.
Containers, y'all.
A fucking container, man. You can get one for 10 grand at Home Depot.
Exactly. Or you can go to any shipping yard, probably get it for cheaper than that.
I'm talking about that's like fixed up, but you got to do your own plumbing and all that. But they literally selling a fucking container for $250,000.
Bro, in 100 years, they're gonna be finding these things all over the place, all rotted out. Oh man.
Yeah, it's crazy. But I want to play this video so we can. I'm going to pause it periodically so we can have a discussion, because I know people don't know. Yeah, this is crazy.
If we do find support here, if it has legs, we could be going right back. I would actually be looking for a bottom somewhere right about where we are, 4,200, 4,300. I feel like the market is right now is very close to finding a tradable bottom or like a bounce for short-term momentum traders. And if this bounce, if we do find support here, if it has legs, we could be going right back up to 4,800 and testing the 2022 highs in a relatively short period of time. It could be reached by like Christmas, which would be a pretty exciting move for a lot of investors to see that recovery.
A recession is still likely and may be declared by as early as late 2023, or at least that's what's being reported in the news today. We're going to discuss how exactly a recession is going to impact markets, how much stocks are likely to decline from current levels, and which assets will do well with our guests today. But first, let me tell you about the news source I'm using right now, which is Ground News, a news aggregator site founded by a former NASA engineer. It's a very comprehensive aggregator. In this particular example, there are 130 articles that pop up on this issue from a variety of sources and viewpoints. What's unique is that Ground News offers bias indicators that give you a comparison tool so you know how the stories are framed and where on the political spectrum the angle lies. From the left, they emphasize the Fed's persistent concern about inflation despite its drop. The center frames the issue globally, while the right concentrates on the Fed's cautious approach in avoiding a deep recession. Reading further into the headlines, like from the left, for instance, we can see that the source is ABC Australia, and there are also ownership, factuality, and bias tags, so you can get a sense of how this article may be influenced. If you're like me and you want to streamline the way you read news, go to ground.news/David Lin by clicking on the link down below, and you'll get a 30% off unlimited access today. Thank you to Ground News for sponsoring this video. Christopher Moulin is here to break this down for us. He is a chief market strategist at thetechnicaltraders.com. Welcome back, Chris. Good to see you as always.
Same here. Thanks, David.
We had you back exactly a month ago. Back then, on the 1st of September, when you were last on, the S&P was trading around 4,500 points. It's retraced to about 4,200 points now. We're speaking today on Wednesday, October 4th. 4,250 is the latest reading on my screen. It's been it's been a bad month. What's going on? Is this just seasonal?
Yeah, I mean, you could say it has to do with some seasonality wise. I mean, I can show you the charts, kind of what I'm seeing here in the markets, and this is the weekly chart of the SP 500. Seasonality wise, you know, the second half of September, the first half of October, that 1 month window is typically a bearish time in the markets. And we have seen that when we zoom in here. This is the weekly chart. The last 4 bars have been down. We might have still a little bit more weakness here, but overall we are, I think, going to be primed and ready for what could be a very exciting and bullish close to the year if the stock market can get traction. And the reason I bring that up is when we look at this big picture here, the chart pattern has got a very nice formation where it has formed a rounding bottom. It's had a very strong rally to the upside. And from a technical standpoint, I like a complex, they call it a complex correction. It's an ABC, or a 3-wave correction, which is A, B, and then C. And it's this C wave down that breaks this previous pivot low, that flushes the market out. In the last 2 weeks, we have seen lots of panic selling across the stock market. Shares are just being dumped across the board. You could argue it's seasonality wise. We have had the Fed come out, talk about rates staying up or going higher. I mean, all of these things are more or less short-term bearish on the markets. But this 3-wave correction is what cleanses the market of weak investors, meaning they're panicking out, and those shares are all landing in the hands of new traders, new investors who are comfortable at this price, who want to hold things going forward. So this is kind of a cleansing, and if this is a bull flag pattern or a pennant formation that's kind of forming, we could see another very big move up going into the end of the year, which seasonality wise, as you know, is a very strong quarter for the markets. And maybe we're going to come up to the 2022 highs. Maybe we're going to blast through those. It's going to be very interesting to see where we go. So, I mean, just to kind of clarify, short-term wise, we are in a downtrend right now. But if this weekly chart gets traction, we could have a very strong rally, and could be a very different picture by the end of the year.
It's just interesting how your process works. Can you describe the differences between your analysis for the short term and the long term? In other words, you're looking at this chart, you're seeing this short term downward momentum, but how do you know, or how do you make the conclusion that at some point this is going to reverse?
Yeah, so the long-term chart pattern here is fairly bullish. The overall trend is up, the moving averages are moving up, and this is a controlled pullback when you look at it from a weekly standpoint. It's still above kind of key moving averages, but if we were to drop to the daily chart, which shows much more near-term volatility, I'll just clear this chart a bit here. We are making momentum wise, we've got the moving averages are now sloping down, our shorter term moving averages. We do have lower lows and lower highs, and you put those together, and the moving averages are a good way to tell you which way the trend is going. If they're trending down, the trend is most likely down. So when the moving averages are falling, price is making a series of lower highs and lower lows. That is an indication that you're in a downward channel or a falling market. And until those change, for a short-term trader, you still need to be bearish. You need to be on the sidelines or being very defensive here, because the market could continue to collapse and fall very quickly. So that's kind of how I like to gauge it. The long-term chart is still, holding up, trending higher. It's in a pullback, where the shorter-term chart is showing that momentum has shifted and short-term trends are down.
Okay. Chris, when you look at this chart, do you think to yourself, I'm going to switch positioning, meaning if the short-term trend is still down, or there's a more of a risk downwards and upwards, let's put it that way, would you stay short or on the sidelines now before you see positive indicators or definitive indicators for a rebound? Or are you just going to stay long and ride this out because the longer term trend, like you said, is up?
Right. So it really depends on the strategy. So our long-term investor strategy, which runs off the weekly chart, is still long, because I do think the long-term charts are pointing to higher prices. Now, for our shorter-term strategy, we're sitting on the sidelines. We exited a little while ago. We're sitting in BIL, which is a 3 to 6 month treasury note, or 1 to 3 month treasury note ETF. So literally, we're sitting on the sidelines, collecting interest each day and just waiting for a new opportunity. So we're not going to try and pick a bottom here. We're going to wait for the trend to change direction, start moving higher, for the moving averages to turn up. And then we're going to look at what other sectors and commodities are doing, and if money is flowing into the market again, or if it is just kind of a dead cat bounce. Sometimes there's not a lot of momentum behind the market. And when we look at majority of sectors, they are all in both a short-term and a longer-term downtrend. So there's not a whole lot of momentum in this market right now. So we need to let the market rally, and we need to see confirmation that a lot of sectors are taking part of it before we jump in. So we won't buy in at the bottom. We'll be getting in at some point once it's made a bottom and is confirming that it's in a new uptrend.
So on Wednesday, we're speaking on Wednesday, the ADP data came out. Private payrolls numbers increased by 89,000 for the month, which is down from an upwardly revised 180,000 and below the 160,000 estimate from Dow Jones. As a result, Treasury yields pulled back slightly, and stocks rose on the day. Can we just take a look at yields, because yields have been pushing markets around somewhat. The 10-year in particular, we've seen levels not seen since 2007. The market is near an all-time, well, not near a 15-year high. What's next based on the charts?
Yeah, I think last time we talked, I was talking about how I think interest rates could, on the 10-year here, get up to 5.5, maybe even 5.75%. I think I mentioned back then, and it is breaking out. When we look at the big kind of massive trend here, we've definitely reversed. We've been in a falling environment for interest rates for a long time. Now they're definitely in an uptrend. We haven't seen this.
All right, this is where people are lost. The 10-year treasury yields. Do y'all know what it is?
No.
Okay. A treasury note is basically a bond, right? You loan the government some money, you buy a bond, the bond matures at a certain point. You understand that concept?
Say that again.
We as citizens are loaning the government money by buying a government bond. Back in the day, government bonds used to be the thing, the tool. You buy government bonds and you would let that government bond mature. Maybe you have a kid who's in first grade, you buy a 10-year bond, and 10 years from that date, it matures. And you get your whatever percentage, 5%, 7%, whatever percentage that this bond is worth. You buy it this year, and in 10 years, it matures and is worth however much you bought it plus the percentage on that bond. Do y'all understand that?
Yes.
Okay.
Yes.
So the significance of the bonds elevating like that means that the interest rates are also elevating, because you can't get a good interest rate on a bond if the rates aren't high. Y'all understand that?
Yes.
So in order for you to I guess reap the benefits of a bond, the interest rates are generally need to be at a higher level, at an elevated level. And if not, you're not going to get a good rate for those bonds. And if you're not getting a good rate for those bonds, you're probably not going to buy them. You're not going to loan the government money. Does that make sense?
Yes.
Yes.
Yeah.
And the reason why you're not loaning the government money is because of the opportunity cost. You could be doing something else. You could be growing that money in a different place than to sit it in a 10-year government bond, or a 2-year government bond, or a 5-year government bond. There are different years. And generally speaking, the 10-year should be the highest earning rate, right, Sean?
Well, it depends. That's why where you get your really the longer, the 30 years should be the highest. The
Okay,
longer
yeah, I guess what I'm saying is the longer they hold your money, you want to make sure that you're getting the best interest rate.
Yeah, the longer term should give you a higher return rate. But please tie this to the stock market though. Like a while ago you said, if the interest rate on the bond is low, people don't want to buy them and they want to put their money in other places.
Right, like the S&P.
Exactly. The
Because
Dow, the
generally
Nasdaq.
speaking, you can get a 6 to 8% return. I guess you can probably Google the rate that you would normally get if you bought. What do they even call that, Sean? The
Okay.
you're
So
buying
let
go
me
ahead, go ahead.
let me attempt to explain it. Okay. So when you Google, average return rates on the stock market, it's going to give you an average of say 10 years, 15 years, maybe the entire time that the stock markets have been in existence. So when they average it out, that's taking the good years and the bad years. So when you go inside the numbers, what you find is the annual return rate might be 7%. The average return might be 7%. And you may look at that 7% and kind of, you may not be impressed with that. But what you have to understand is in years when the interest rates are low, that 7%, you're not going to return 7%. You're probably going to return 15, 20, 25%, which is impressive. The reason that annualized or that average return is only 7 is because it's over a lot of years and it's taken into account the bad years. So hopefully what everybody can take from this is when they start raising interest rates, you see the markets correct or overcorrect. But when they start cutting them,
Don't say correct. Say what it is.
the market goes down, you know, when they raise the rates. And when they cut the rates, the market goes up. So I know a few weeks back, maybe it's been a couple of months, you know, we keep showing everybody, you know, the NASDAQ, the Dow, you know, we go back to 2008 and you see this huge uptrend. It's because they cut the rates. And I don't know the time frame on this 10-year note, but the 10-year note chart is probably going to look the exact opposite of that market chart if you overlaid it, you know, using the same time frame. So what the point here is, the relationship is going to be the inverse. And the 10-year, for whatever reason, I don't know why, it's the most sensitive. You know, it's the, you know, nobody look, we don't, they don't pull up the 30-year treasury note or the 2-year. They like to use the 10-year to use as a gauge. And if the 10 years going down, then they want to put their money in the markets. When the 10 years going up like it is, they tend to want to pull their money out of the markets. Anyway, that's all I got.
Okay, so
Wait, hold on. I have a question.
I got one too. So
You said when the curve would be inverse, so that means when the 10-year goes up, that means the interest rate is also up, or is it down?
It's the 10 years a reflection of the interest rate. So if the 10 years up, that means the Fed's fund rate is up. If the 10 years down, that means they've been cutting. The inverse relationship is the equities markets, the NASDAQ, the Dow, the S&P, y'all's German 30, the UK 100. Equities will be the inverse of the interest rate charts. That's why when they raise rates, the stock market loses money. It goes down in value. When they cut rates, the stock market goes up. So it's like he just said, if you're only going to give me a bullshit 2, 3, 5% return, well, maybe 5 is not a good one. If you're going to give me a low return on bonds, I don't want to be in bonds. I want to be in stocks.
Mm-hmm.
If the Fed raises the rates up to 7% like they are now, then okay, I want to be in bonds because I'm not going to lose my principal. So I'm going to pile my millions of dollars in bonds and get a 7, 8, 10% return on them. I don't want to be in stocks. It's too risky.
Mm-hmm.
You know how we talk about risk on, risk off?
Yes, that was my next question.
Right. That's basically the game that they're playing.
Mm-hmm.
If you're going to give me a healthy return on a bond or a treasury note, and there's no downside risk, I'm not going to lose my principal, then why wouldn't I take that?
Yeah.
So, and I know Elfie, you have another question. So hold on real quick.
You're good.
When this is going over the top, we're saying it's inverse, like, and I think about rug pulls. That means when that thing drops dramatically, that means the people who had the money at the top took the money out and then it fell, right? I don't think this has anything to do with that, but does it?
So I'm not an expert on exactly how the bonds work, because you can't take your money out,
because it's a contract.
Right.
Yeah.
But the reason these things fall is because the Fed funds rate gets lowered. So you might be locked into whatever deal you signed when you bought your bond, but these things are being sold every day. So the future guys aren't getting the return. So the new money's not coming in, which is why the chart starts sloping downward, if that makes sense.
Right, but you can't lose any money just because it went down. Your bond is secure. That's
Exactly.
why it's a bond, right?
Exactly.
Okay.
Right.
And one more right here, this is 2009, right? And the reason this is not a mirror image, right? I'm still researching this, but the reason this is not a mirror image to the stock market is because of the games that Chair Powell and them play with the balance sheet. right? Sean, remember I was talking to you about how they're canceling, how they're raising the interest rates, but they're not doing anything with the back end.
Yeah.
That's why this chart isn't a direct inverse of the equity charts. But it does go in the general direction. So when the interest rates dropped to zero, the chart trended down. And then in 2021, right? In 2021, when they raised the interest rates and the stock market started falling, the bonds market started going up. And you're going to hear this guy say that when the bonds market gets too high, you have a crash, right? It's the same because the interest rates are too high. No companies can borrow money. They lay people off. The market crashes. The stock market crashes. And when the stock market crashes, the interest rates drop, which causes this market to crash. And as this market is crashing, the stock market is rallying.
Yes,
So,
sir.
does everybody understand that concept?
Yeah, it's pretty straightforward. They both can't do good at the same time.
Right.
It's either one or the other.
Yes, that's generally how it's going to work when it comes to these T notes, these bond
And
markets.
it's good to have this conversation because the idea that, oh, that chart is going down, that means this chart should be going up. That's not what that means. And that's confusion, right? You got to get out of confusion and having these conversations to get everybody laced up in the right direction, that we're reading everything the way it's supposed to be read, that you don't get yourself caught in some mess.
Well, OG, I would beg to differ a little bit here, man. I mean, it's not going to be exact,
Right.
so to speak, but if this chart is trending down, those equities charts will be trending up, because when you see this chart going down, what that's essentially telling us is, hey, there's not a good return if I buy bonds or treasuries. If I loan the government money, they're not paying me anything. It's like if I loan you money and I'm like, hey, OG, I need interest on my money. And you're like, hey, I'll give you 2%. I don't want to do that. I can put the money somewhere else and get a better return. So if what this chart is essentially doing is it's telling us, the return on bonds or treasuries, which is essentially a loan to the government. So when this is moving down, that means people aren't buying these because they perceive that they can get a better return, most likely in the stock market. And when this is going up, what that means essentially is they have taken their money out of the stock market because the stock market is quote unquote risky, and they put their money in here because this is not risky. If they could consistently get a 7, 8, 10% return on this, I would submit to the group that people would just always keep their money in this because there's no downside risk to this.
Okay, and that was going to be the question, is it cyclic? So the idea is it's going to go back to resistance, this chart.
Yeah, because at some point the Fed is going to stop, they're going to stop raising rates, and ultimately they're going to lower rates.
Right.
So that's what moves this chart up and down essentially is the Fed's funds rate. That's why that rate is so important. That's why everybody hangs on everything this guy says.
On Fed Powell, everything that Fed Powell says.
Right. Because he's the one that controls this rate. He's the chairman of that body that they call the Fed. So people that have economics degrees and, they got all this time in the market and they understand, economics, they understand that rising interest rates are the number one killer of a bull market. And this is why, because if I raise rates, that means, hey, I can get a good, healthy return if I just go buy a bond. The attractive part of buying a bond, like I said, is there is no downside risk. I will not lose my principal. When I trade, when I buy stocks, I can lose my principal or it can decrease. Trading, you definitely can lose your principal.
He's going to talk about that here in a minute too.
Okay, Todd, I'm sorry, before you continue. Sean, so just so I understand this right, back to the risk on, risk off. Basically, bonds are kind of like the JPYs, like another option when something isn't, I mean, when I would want to be risk off.
Not exactly, Elton.
Yes,
And
okay.
this is what I mean. If you buy or sell the JPY,
You can lose money.
you can lose your principal.
True. And with
You
bonds,
buy this bond and the return rate is 1%. If you put $1,000 and buy this bond, you will not lose money. But when you come back in whatever the maturity date is, 5 years, 10 years, 30 years, you're only going to make 1% on that principal. Most rich people, hell, most poor people, you want to make more than 1%. You're giving people your money.
Let me add this. Let me add this. No matter what happens in the market, right? That's the thing. If you were supposed to make $500,000, your contract only said 1%.
Right. It's that time and opportunity cost, you know, and maybe somebody that works in a bank, you know, or somebody with an economics degree, they can speak a little bit more intelligently about that. But there's a time element, kind of like when you buy on puts and calls, you know, there's a time decay element. What they're basically driving at is if you tie your money up somewhere for X amount of time, time is money. And, you know, when, like I said, when you give your money, when you buy one of these bonds or make a loan to the government, you want it to be at a high rate, you know, because you want to make money. So again, I'll say this one more time. When the Fed lowers interest rates, that interest rate is tied to the rate of return on these bonds. So when rates are too low, people will not buy these bonds. They will put their money in stocks and crypto. When rates are high, and I don't know exactly where that threshold is, let's just call it 5%. It might be a little higher than that. But when rates are high, people pull their money out of crypto. They pull their money out of stocks, particularly tech stocks, and they buy these bonds, or they park it in money market accounts that are going to pay them a decent, healthy interest rate, and they don't have to worry about losing the principal. That's what drives this market and the stock market. Again, that's why everybody hangs on every word that Powell says, because rates are high right now. I mean, we all think the market should be lower than it is, but rates are high, and regardless of where the market sits, if we all perceive that rates are high and he's going to stop cutting or stop raising and eventually start cutting, the reason we're hanging on every word is because when he starts cutting, we all know the stock markets are going to go up. That's why everybody hangs on every word that this guy is saying. Or when we first started raising, they were hanging on every word because the stock market was up and they was like, do I need to sell? Do I need to take my money out? Do I need to buy these bonds? You know what I mean? So that's why every time this guy opens his mouth, everybody's hanging on every word and reacting and shit. That's why you get the crazy movements, you know, when he talks every month. And I say, fuck, you can't trade, you know, because this dude opens his fucking mouth every week. But that's what's going on, basically.
So my next and last question, hopefully. So when let's say I bought a bond, maybe 5 years ago with a 3%. And last month, just as an example, he raised it to 5.5.
You're getting 3%, Elfie.
Huh?
You're getting 3%.
Yes. So, but if I want to buy a new bond, then I will get those 5.5% now, or
Yes.
Wait. Hold on. Okay, so here it is right here. You bought it at whatever the percentage was. Does that percentage change if the percentage
No.
changes?
it
No,
should.
it doesn't.
It's
These are
Right.
fixed rates, guys.
fixed, all fixed.
Yeah, whatever
Yes,
you
I
buy it at,
understand
that's what it is. You can buy
Yes, I
it used.
understand that part.
Here's the other thing I would say, and I'm just going to throw this out here because I'm not an expert, but remember a while ago he was talking about mortgages. You know how in Canada they buy these short-term, basically have these arms and they got to go back to the table every 3 to 5 years.
At the beginning
In Canada,
yeah.
so they're going to be more subject and sensitive to whatever the rate is, you know, when they got to go back to the table. Well, there was something similar in 2008 in the American economy, but ours was a little bit different. You know, our people didn't have to go back to the table. Our people were just simply tied to the market. So as long as rates continue to drop, then their mortgages remain affordable. Maybe their mortgages may have even dropped. I don't know. But when rates went up, their mortgages became unaffordable, which triggered all the foreclosures. So the reason I say that is because my understanding of bonds, the only bonds I've ever seen are when I sign that note, when I'm agreeing to whatever that interest rate is on that note, 3%, 5%, 10%, whatever it may be. There may be a bond out there that's similar to the ARM, where it kind of changes with the rate. I don't think there is, but I'm not an expert. I don't work in banking. I don't know.
And we're not discussing those. What we see on the screen is not that. It's a fixed T rate. It's a 10-year treasury note.
Right.
Yes. So, but my question was really about the bond that I'm buying now. Because I understand that bonds are like at a fixed rate, but the bond that I'm buying now at the 5.5%, let's say, for instance, is going to be at that particular percentage rate, or does it also increase, I don't know, incrementally or something? Or is it that rate that
it's going to be fixed?
It's going to be fixed.
so it's the fixed rate that the federal government, I mean, that Powell talks about?
Yes.
Now we're so and okay.
So
yes.
look at the right side of this chart. It's giving you the percentage rate that these bonds are actually at. See how it's close to 6% or is moving up towards the 6%? Maybe it's around 4 or something right now. That's the real time rate.
Even though on the global rates website, we see that the US dollar is at, yes.
That is the rate they're going to charge you. That's not the rate you're going to get. You understand? The global rate is the interest rate that the federal government is charging to loan money.
Okay.
That's not the rate they're giving you to borrow your money.
Okay.
Obviously, your rate is going to climb as their rate climbs, but they're not ever going to give you the equal. That's like when you go to a foreign exchange counter in an airport. You're never going to get the best exchange rate.
Yeah. Okay, that's what I wanted to know, if it's the same rate.
Yeah, it's not exactly.
And you see how it's all tied together. When you take your trade, that's why you don't get the exact position. It puts you at the disadvantaged position. That's why your entry always opens up in the negative.
Yep.
Okay. Thank you.
I have a question. So how do you, like, when you buy a bond, right? Like a 10-year bond, I heard, like, do you get paid every 6 months, right?
I don't
Or do you get paid?
I don't work at a bank, and I've never bought a bond, so I don't know what the payout dates are on that interest. That's what
Yeah.
you're
Okay.
interest rate.
I'll just
Um,
have to do some research.
There are bonds that pay out like every 6 months.
Okay. And is it like, are you getting the interest, like say like 5% every 6 months on your money, or are you just getting it in increments till it matures?
It has to
Yeah,
be.
it would be in increments.
It has to be an
Okay.
increment.
And that's
Okay, that's
all
pretty
part
cool.
of their system. Like you get to doctor that thing up the way you want. And then, according to whatever parameters they're giving you.
Yeah.
Yeah.
And probably all of them, now that I think about it, probably all of them pay in increments. And this is what I mean. When you sign that contract, they know what your principal is when you sign the contract, and they know they got to pay X%, whatever the rate is on that bond over X amount of time. So it's easy to calculate what X% on the underlying principal is on the spot. And it's easy just to do the math to divide
Yeah.
up. You know what I mean? So
Yeah.
that's probably how all of them pay out. But again, I'm not an expert in that field.
That's pretty cool because you could basically like figure out how many bonds you need to buy to pay for your bills every 6 months and just have everything paid by bonds.
And that's
I think that
special.
used to be the primary way that people paid for college.
Yeah. That's smart, very smart. But we don't get taught this stuff. This is a secret.
Right. And it attracts us. There's some of us are built to be attracted to
Mm-hmm.
there's more to that. I need to figure that out. Like we're addicted to doing that, right? I'd like to get in there and figure it out. Like, what is it? Like, I want to know how to figure out how to cover every single cent in my bank account because I'm becoming my own bank now. So I got to be able to manage that. And I want to
Yeah,
know.
but
Yeah.
there's like no point in having money in the bank. Like literally. I mean, obviously,
Right.
yes, so you can like
Yeah.
spend it, but you might as well put it somewhere else and just have it, come back to you little by little.
We're
Well,
we're transferring over.
This is the only thing I would say. I would say for the majority of definitely you younger people on the call, for probably all of your lives, the majority of your lives, what she just said is correct. There really was no point in having money sitting in a savings account. There was no point in buying bonds because since the early 2000s, the rates have been pretty much held at zero. So you can't get a return on your money. So the money must go somewhere else. Stocks, real estate, crypto, whatever that something else is, that was really the only place you can get a return. So now, since 2021, those rates have been coming up. So if you can get a bond at a 7 to 8%, or if you do have a account out there that's paying, I don't know, 5, 6%, depending on how much money you got and your risk appetite, maybe it is worth it to use those kind of instruments because there's no downside risk.
Mm-hmm.
So that's the game right there, and at some point it becomes, a personal decision. I mean, if I feel like I'm too good for 7, 8% returns, then, my money won't be in those kind of things. But if I'm risk averse, maybe my money is. If I got $2 or $3 million and I can park my money somewhere risk-free and get, 5, 6% return, that might be very appealing to me.
And
So
it's such an
what you're
easy
saying is-
call.
Say again?
It's such an easy call.
Right.
Because you just sit it there.
Exactly.
Yeah,
That's
Sam
what they want.
Bankman-Fried.
They want confidence. They want something that's for real. Okay, there's no doubt about it. Yep, put it here. There we go. Put it there. They don't have to worry about the things we worry about.
Sam Bankman-Fried probably wishes he would have parked his money in us.
Yeah.
Yeah, he's one of the biggest idiots of all time. I mean, do you know how hard it is to lose $10 billion? I mean, trading. I mean, what are y'all doing? I mean, how is that possible? put the money. I mean, even if you're only getting a 2 or 3% return on 10 billion, I mean, how much is that? So
he sent me a text and said him and Epic was trading the US 30, and
Don't put me in that one there. Don't put me there.
he said he used he said
I'm
he
not.
used 4,000. He said he used a 4,000 lot size on the US.
I am not associated
He
with
said he
that.
was talking to you, and you talked him
Uh-oh.
into swinging for the
Start the
fences.
video. How about that?
Oh my God. I'm just joking with you.
wow. But all right. That's all I got. Anyway.
Okay, yeah. So I kind of just wanted to point that out. So I'm gonna let the video continue, but I wanted everybody to kind of understand what a T note. I know y'all hear T notes or you hear bonds, but a lot of times we don't talk about that as traders, and we don't understand what drives those prices up, and we don't understand why they get on the financial shows and they complain about high T notes. Most traders or stock market investors will complain when the T note level gets too high. They don't like that. All right, let's continue.
This price level since 2007, which is kind of, right when the stock market actually started the last major correction and went into the financial crisis. So it's interesting that we're coming back to this price level. And I feel like the market is, while the stock market's holding up and doing all right, I feel like the behind the scenes of the economy are slowly crumbling. People are starting to, I think, be concerned about money. And the rates and mortgage rates are changing so fast. I was talking to somebody last week, and they have 1.9% mortgage. It comes up for renewal in March, and he's very worried and frustrated because he could have sold his house about a year and a half ago for about $250,000 more. He's listed it now for 250 grand less, and he can't get a bite. He can't sell it. And when his mortgage comes up for renewal, his mortgage rate is going to triple. And he's like, I don't even make enough in a month to pay for the mortgage. And so I think we're going to see this. This is in Canada. There's 3 to 5 year mortgages are the most popular, and we're going to start seeing the 3 years coming up in the 5 years. And it is going to be a nightmare because of these high rates, mortgage rates. And I think they're even higher in the States. I think mortgage rates are up around 8% in the States versus 6% here in Canada. So I think we're, just tip of the scale. We are right back to interest rate levels that we saw the last financial crisis take place. Homes are way overvalued. They've shot up so high, and now everybody's going to get hit with a really high mortgage payment when they go up for renewal. And if we get into a recession and jobs start getting cut and employees start to get nervous, the banks are going to tighten up, and it'll be even harder for people to renew their mortgage, even if they have the funding to potentially support their new interest rates. So the whole area around interest rates and mortgages is going to be really interesting, where we're kind of headed.
I'm just curious, in this particular case, if somebody's not able to cover their mortgage payments when it ticks up, what's the option here? If you sell your home and buy another one, you're still paying high rates.
Right. Well, they would go to rent, right? The rental market will get very strong. They have to liquidate and rent, and that's just kind of the way that goes. And of course, the house will go into foreclosure. That's something my dad used to do years ago. He used to pick up banks. The banks would actually call him and his partner, say, listen, we got all these properties. Which one do you want? Give us a bid. He used to be huge into real estate. So that's something that we could walk right back into, which nobody's even really thinking about it, or at least the general public. They don't realize the danger that's really around the corner, I think, when it comes to real estate risk.
I think the other risk is that some people think that just because the Fed is probably done their rate hike cycle, that rates are going to come down. It doesn't always follow perfectly. And in fact, there's probably a bit of a lag, right? If you see the Fed stop raising rates, it doesn't mean the mortgage rates are going to stop raising. And conversely, if the Fed drops rates, it doesn't mean interest rates on debt and mortgages are going to come down right away. Is that something you've noticed?
Yeah, for sure. I mean, even after the 2008 financial crisis, the market bottomed in 2009. The housing market was, the softest in 2012, like 3 years later, at least in Canada here. So there's a huge delay. These are massive trends that and changes in the financial system that take a while to work themselves out. People don't get affected until they come up for renewal. So there is definitely a big delay in all of these things. You might be good now, but it's going to catch up down the road.
Okay, so let's just recap the S&P 500. I want to move on to a different segment. What's the floor you're looking for?
I would actually be looking for a bottom somewhere right about where we are, 4,200, 4,300. I feel like the market right now is very close to finding a tradable bottom or like a bounce for short-term momentum traders. And if this bounce, if we do find support here, if it has legs, we could be going right back up to 4,800 and testing the 2022 highs in a relatively short period of time. It could be reached by like Christmas, which would be a pretty exciting move for a lot of investors to see that recovery.
I think that's a very optimistic outlook. But I'm looking at the same bounce. We talked about how the dollar needs to pull back after 12 weeks of buying. That's the bounce. It's the same bounce that we're seeing. Now, whether the dollar just sells all together, I think it needs to push up to the 110, 111 area. And I don't, if the dollar pushes that high, we not bounce. We're going to bounce and then drop.
To clarify, when you said that we're in a short-term downtrend, you were talking about what has happened the last month, right? You're not talking about this downtrend continuing because you said we're near a bottom. Am I correct?
Right. The pullback we've seen in the past month and a half, I think it's about to find a bottom here, and then I think we could go higher to test the recent highs of 2022.
Excellent. Well, Chris, let's try something a little bit different. Instead of going to the next chart, I'm just going to ask you what you're most bullish on right now. Could be the stock markets that we've talked about just now. Could be something else.
Yeah, I would say it depends on the time frame you're looking at, but I mean, the dollar typically does well when there's fear. I think the dollar's gonna have a little bit of a pullback, but overall, I think the US dollar index is going to continue to rally fairly significantly. In terms of another asset, I mean, if the markets are going to have a big correction, I don't really want to hold a whole lot of stocks. Really, I have to follow the trend. Right now, the trend is down for stocks in the short term. So to me, the dollar is kind of the one that's trending up very strong. You can be in another type of position, which isn't all that exciting, but bill, which is the treasury note, which you can just kind of collect monthly interest and dividend payments until there is a decisive move. Right now, the markets are oversold. And I think trying to short a market here is a high risk play. I think trying to pick a bottom or trying to play a bounce is also high risk. So the dollar and the sidelines right now until we get a new decisive move in a direction here is kind of what I'm looking at.
It's interesting. I'm looking at the DXY in 2007, in October 2007. The dollar, the DXY was reaching a trough. It bottomed around April 2008. And all throughout the recession, it peaked until it peaked at around 84.6 in 2009, January 2009. So it actually shot up during a recession. Some people were saying that the dollar weakens during recessions. Maybe it has in other recession cycles. I'm just looking at 2008. And we saw a big rally in the DXY during a recession. Does that make sense intuitively to you that the dollar would rally during market volatility?
Yeah, it does. I mean, we saw the same thing back in the 2000 tech bubble. The dollar screamed higher. I think we're actually much more closer to a 2000 kind of market reset that could take a long time to unfold. And I think the dollar is going to go back up and hit what we saw back in 2000, which is around the 120 mark. But typically we see when there's blood in the streets, there's huge panic. The dollar is the one that really goes up in value, and stocks and everything else plummet. So to me, a very strong play during a recession is actually the dollar. That it's just played out very well in the past, even on short-term charts. The stock market sells off really big, the dollar tends to go up. So it's just kind of the way that I found that the dollar seems to move. And I really like it because it's a fairly consistent moving asset class. It's not really volatile. So a big day in it is like 0.5%, 0.75%. So it is a very controlled way to kind of manage your money and take advantage of weak times.
What's the trader's logic here for flocking to the dollar during times of volatility and risk off? Because you would think that during a recession, this is my logic, and correct me if I'm wrong, you would think that during a recession or during periods of downturns, you would expect the Fed to perhaps loosen monetary policy or cut rates, which would bring down the dollar, assuming other central banks aren't more dovish. What am I not getting right there?
Yeah, well, I mean, nobody knows for sure, and I think you've got a good point. I don't know if people just pile into the dollar and drive the dollar up. I think the currency market moves more as a global kind of school of fish, and when people get nervous that the recession's coming, weak times are coming, it's not just in America. It'll be in other countries, and they'll naturally kind of want to flock to a currency that they're comfortable with. And the US is still seen as kind of like the global power, the reserve currency. So they might sell their own currency and move to the dollar, especially if it's trending up. Then people are going to want to move their money to a currency that is increasing in value versus holding their own that's falling. So it's kind of, once it's trending up, it actually helps feed more investors to want to hold different currencies.
So,
Translation, we already talked about how the US dollar is considered and I'm putting my air quotes, a safe currency, right? That's all, that's basically what he's saying. The US dollar is considered a safe currency.
similar time frame for the next question. What are you most bearish on right now?
Most bearish on. What time frame are we looking at here? Are you saying like 6 months out?
We have to compare apples to apples. So the same time frame that you looked at for the DXY will apply the same analysis for a bear call.
Gotcha. Yeah. Well, if that same applies, then I would say equities markets are going to have some of the biggest downside potential here. I think they could fall 30, 40, 50% fairly easily if this unfolds.
Okay. That's after the rally that you talked about, right? Just to clarify.
Correct. Yeah.
Okay. Very good.
If the S&P rallies to 4,800 and it falls 30, 40, or 50%, that's catastrophic. So if you overlay that same analysis on the US 30, if the US 30 rallies to 35,000, 34,000 and falls 30, 40, or 50%, that would be considered catastrophic. So I hope that it doesn't fall that far, but if it does, I mean, we should see it, and that we see that.
What you mean?
Hey, that's that.
I want it, catch it at the top, let it drop. Hey,
well, I agree, but I mean, this is when you see some of the staples, some of the companies that we're used to won't ever come back. It is what it is. It's survival of the fittest. But what he is saying is crazy to think about. Like the stock market falling 30, 40, or 50%.
Todd, let me ask you, with the things that you know right now,
it would be lovely. But
in any company, having a person like you around and they're just trusting what you're saying, how well that company would do.
Well, I agree, but my point is, the bigger point is this: we all have to live in this country. I guess we don't all have to, but we all do live in this country, and we have family and friends in this country. If that stock market dumps 30, 40, or 50%, I mean, I can't help but think we're talking about a different America. At least it's going to look a little different.
It's going to be feet to the fire, and that's what it's supposed to look like. We don't know what it's going to look like, but we're about to find out.
We don't have a truly we don't live in a true capitalistic society. So I mean, I would be shocked if something happened and there was a big sell-off, they would pull the plug on trading before they allowed that shit.
Yeah, they would. They would cut the machines off. Huh?
Yeah, they always do. I mean, so I just I don't see that happening.
Yeah, that dude said 30, 40, or 50%. I'm like, yeah.
I mean,
Like,
I'm wondering where would that be though?
They didn't cut the market when the COVID dip happened.
was that a 30% or 40% drop? I guess maybe it would. I mean, I can see maybe that kind of drop over multiple weeks or a couple of months, but not in a day or two, maybe not in 1 week, because they do, most of the time they do pull the plug. And I think the only reason they didn't pull the plug during COVID is because Powell came out and said they was buying everything. Basically they infused a shit ton of liquidity into the market, which is why we got the explosion to the upside.
Well, wouldn't we expect that to happen again?
Well, yes, I
Yeah.
would, so, I guess what I'm saying is we either getting liquidity or plugs is getting pulled, but just a true capitalistic plunge to the downside to wash out all the over leveraged people, et cetera. I don't see that happening. I don't think we'll ever get a Great Depression, because that's essentially what happened, in 1929,
Yeah.
when we had, it was more of a true system, and whoever wasn't right got ransacked.
So being on the opposite end, we're saying it's not going to happen. All right, then we're getting bullish chalk with a tap in. That's what that means.
Yeah.
Well, where would it go to if it goes down 30%?
Whatever. I mean, if it's a
Yeah.
low, it's a low. I don't see trading being disabled. I see maintenance on sites and brokers. I see taking MetaTrader off of off the Apple site,
I don't
stuff
think.
like that.
OG, we don't mean, I mean, when I say pull the plug, I mean like pull it for a day, for a few hours.
Yeah.
Just stem the
Like
bleeding.
freezing trading on Wall Street.
Yeah. I haven't lived that yet. I've seen it and I've heard of it. I haven't experienced it yet, but I have seen it.
Yeah.
Yeah. Well, I think they kind of implemented those rules after the 87 crash, right, Sean?
Yeah, I believe you're right.
Yeah. So, maybe the .com crash could have, like, I know that they implemented those rules during that crash. So maybe it would have went deep enough during that stock market crash. But this dude is saying he sees the market dropping 30, 40, or 50%. Me and Sean, you were talking, when were we talking? I said I thought the market needed to go to 17K.
Yeah, I don't know. It's been probably a year.
Yeah, so on the charts you can
that's what it suggests.
Yeah, you can see how that's logical, but to actually say that and to understand what needs to transpire to bring the markets all the way down there, it has to be some catastrophic. It has to be something catastrophic. I can't see the market just trading down there.
Well, it might be the government shutdown might do it. But because like it's similar to the Bitcoin chart, the chart suggests that it needs to go to 12, 12, 13, somewhere down there. It has not been down there. But the chart suggests that it needs to go down there. But what's going to push it down there? I don't know.
Yeah. So, it just, so everybody,
well, let's say this, it's already done the first part of what it's supposed to do.
yeah,
So you just keep following it, right?
Well, that's true. That's true. Just because
you're right,
it doesn't mean it won't happen.
Yeah, I mean, it could. I mean, but I guess all I'm saying is, to me, there would need to be probably some news event to push it down there. And the only thing I can see potentially right now that might do it is if we had a government shutdown and it kind of persisted and it became a contagion and that leaked into other parts of the broader market. And maybe we we get pushed down there. But
Or something happens with the SEC, or one of these brokers goes down again, something like that.
yeah,
Yeah, but even if one of those events happened, it ain't pushing it way down there.
yeah, I think it's unlikely.
Yeah.
Yeah.
What about war?
I'm sorry, go ahead.
I said, what about war?
And it could.
But yeah, war could, but so I don't want to get on a tangent. I just kind of wanted everybody to kind of appreciate what this guy just said. Like,
I like tangents. No, but go ahead.
I mean, that's to me that would be in the deep doo-doo territory. You know what I'm saying? If we losing 30, 40, or 50%, like, so just so everybody understands what he's saying, and this is just, I think he's basically saying what he is seeing on the chart, which is cool.
If we do lose that kind of money, on that crypto chart, I'm all in.
Hey, I'll be right there with you.
I am all in,
Ethereum specifically.
Hell yeah, and a few other things, my wife gonna have to be mad at me because money, significant amounts of money is coming up out that savings account.
Let's roll.
Let's talk about some assets that you mentioned to me offline that were interesting. Uranium and uranium stocks had a big move. Can we comment on that?
Yeah. I just find it's really interesting. I noticed this yesterday when we had a mentoring session with subscribers. We look at uranium. I'm just going to flip back to the daily chart here. If we take a look at uranium stocks, we've seen from the lows here, we've seen they're up about 41%. And it's funny because uranium stocks, as you might have quickly saw a glance there, if we go way back in time, they used to be valued very high. They have been out of favor for a very long time, and they're just starting to come back to life now. And that's a lot of it has to do with uranium not being needed as much, people not wanting to deal with it because people have this belief that it's a very dangerous and dirty energy, which you could argue both, but I think it is a relatively safe way to generate a lot of power in the long run. But this so-called dirty, scary energy is rallied 41%. And when we look at, for example, TAN, which is solar, which is supposedly clean energy, and we look over the exact same time frame, it is down almost 50%. So it's really interesting how two kind of extremes are kind of moving. And I don't know, somebody would probably argue that uranium might actually be a clean energy. I've heard cases for both sides, but it's just a very big different move between these two extremes of kind of energy production, which I thought was really interesting. And the whole solar space was on fire after the COVID crash, and now it's fizzling right back out. And I think it's got, I think a lot of these stocks have got a lot of room to still fall. In fact, if we take a look at the ARK-K ETF, you can see here it was one of the most popular ETFs. I swear everybody piled into it, and it's all they wanted to own. And even though the stock market is like equivalent to trading right here, right now, anybody holding these growth stocks are down, from the highs 76%. And what we've been seeing is a lot of this rally that we've seen in the stock market this year. A lot of stocks are floundering. They're refusing to rally back up. There's not a lot of participation. Saw this just the other day. We saw the stock markets close had a somewhat positive day, but almost every sector was down. And it was just a couple of tech companies holding the entire index up, masking this kind of false belief that, the markets are doing okay. They're holding up. But the reality is most people's portfolios are plummeting while the stock market is up trading near the highs, and people find it very frustrating, but they don't understand how the markets move. And if you hold specific types of sectors or stocks during different stages of the market, you're going to dramatically underperform. And this is the scary thing is, this is trading down here. This is consolidating. And this could very easily start a new leg to the downside. This is a bearish pattern that could resolve down into the teens, which I've talked about. I think I even mentioned it to you many, many months ago that if we go into a bear market, these ARK ETFs are going to completely crumble and fall a lot more. And a good view of this actually is the Russell 2000. If we look at the Russell 2000, it put in a kind of a topping phase through here, and then it had a big measured move, a big breakdown, and now it is consolidating, just refusing to get traction. And that's what the market does. It has a pause and then drops, and pauses and drops. So the markets are very, very, they're not super strong. This rally this year has been just a tech-based rally. There's not a lot of participation across the board. When the tech fizzles out, we are going to see things, I think, plummet, and the dollar will rally, and equities are going to be one of the dogs you just do not want to hold.
I'm just thinking the Russell 2000 has been flat all year. And of course, it doesn't include the big tech stocks. Even if the tech stocks fall, I wonder if the mid caps are going to do okay. What's your take there? What I'm getting at, Chris, is if we just take the big tech companies out of the equation completely, what's the rest of the market going to do?
I think the rest of the market will fall. I mean, I think there's a lot of weakness in selling. And if the big tech companies fall, typically that means people are selling not just the tech, but they're selling everything else. The money's either flowing into the markets or out. The tech, the tech definitely helps leverage and hold the markets up. But if the techs are going down, it's going to, even if you take them out of the market, if techs are going down, people are still selling their other positions as well. And small cap stocks, mid cap stocks don't have the same liquidity. They fall even faster. And it's just kind of like, the smaller they are, the easier they can fall.
So typically during a risk off environment like that, when people are selling their tech stocks, moving capital away from the big tech companies, perhaps even other blue chip stocks, where does that capital go in this environment, historically speaking?
Yeah, I don't know. I mean, everybody's got their own thing. Some people shuffle into metals. A lot of people go into Bitcoin. Some people are going into dividend paying stocks, or generally in the past, we've always seen bonds and utility stocks as kind of places of safety. But I mean, if you've looked at utility stocks in the past week and a half, they have fallen off a cliff. And
well, he said they put their money in bonds. Did you say that?
Sector ETF, and people.
You said what, Sam?
He said he put their money in bonds, right? In the past.
Yeah.
Kind of going back to that conversation. Money's in the bonds because the interest rates are decent and the principal's safe. So I just wanted to reiterate that point.
People go to these kind of conservative, slow-moving utility stocks has completely fallen out of bed. And I mean, it is dropping. I don't know what it has dropped percentage-wise from the highs, but I mean, that's down, almost 30% for what's supposed to be a conservative play. And that's just like the bond funds. They're down over like 50%. And that's why I don't believe in the same old strategies of buying and holding, and bonds are a defensive play. That's why I use technical analysis. If something is trending down, we're not in it. We'll exit it, or we'll find something else that's going up. I don't believe in holding. I hear this all the time. They're like, "Well, I'm moving to this fund, or this company's got a great dividend. It's like an 8% dividend." And then it drops like 10% in a week. I'm like, it doesn't make a sense to hold something that pays you 8%, but then it can drop that in a day or three sometimes. People are lured into this.
Wait, what kind of company pays a 10%? What kind of company pays an 8% dividend with that kind of volatility? What are you talking about? What are we,
I don't know, maybe self-storage. I just pulled a number out of a hat, but
okay. I mean that I wouldn't want to be there either, Chris. That's making a good point. But Chris, let's talk about. I'm curious. Just speaking of divergence, let's talk about the metals. The gold bullion has been flat. It's slightly down about 1%, down about 1% on the year. I don't know if you factor in the latest price movements from the last hour. Maybe it's moved a bit more. But anyway, it's slightly flat on the year. But the gold miners, if you take a look at the GDX, for example, that's like down 11%.
Yeah.
Why the big divergence there? If you take a look at the rest of the markets, the stock markets are up. So you can't say that, well, the stock markets are pulling down the rest of the equities. Like, that's not the case, right?
Mm-hmm. Well, precious metals and mining stocks have a really weird relationship. Sometimes they move with the stock market. Other times they'll do the exact opposite. Stocks fall, gold miners go up. And then you got to throw into the mix kind of the US dollar, which, you know, when this most recent move, I think with the interest rates, you look at this sharp drop in gold, miners, and silver, and then we just look at it quickly to the US dollar. You know, it has been this strong leg. It's almost been a mirrored move in opposite directions. So, you know, when you look at the miners, they are the speculative play when it comes to precious metals. Gold's holding up because it's the global kind of, I don't know, physical reserve currency that people see. Gold moves slower, so people can put more money to it and be comfortable. Where silver and miners move super fast, you wouldn't want to just go dump like $1 million into it and lose 8% in one day. You know, you go to gold and it'll move 0.5%, something that's palatable, that has a little more controlled of a commodity. So these speculative moves, when people are nervous, they move away from miners, they move away from silver more so than gold. And because these are dropping faster, people might actually want to hold gold more so just because it's holding up better. So it's a very difficult, the precious metal space is difficult to trade because it flips and flops between moving with stocks, moving the opposite of stocks. And then we have the dollar involved in interest rates, and all these things just make it a very difficult scenario. A lot of people, you know, so many people love precious metals and miners, and I do as well. There will be a time when they're going to be absolutely amazing. Hopefully sometimes next year we see a major rally in this space, but they're very difficult to trade unless we're in like a really strong bull market phase. You have to be very aggressive. You have to be very short-term trader because every pop is followed usually by a big drop. So they're a tough beast, and people trade them thinking they should be easier and they like them, but it is actually a very tough, I find, sector to trade.
But when you see this divergence between the miners and the underlying metal, do you think to yourself now is a good buying opportunity, or do you think that maybe something's wrong with the sector and I should stay away because it's underperformed the underlying asset?
Yeah, I mean, the fact that it's underperformed, like, you know, gold has been trading to equivalent to chopping way up near highs, near like, you know, previous highs. We've seen this divergence, as you just said. And so if the market goes into recession, the dollar rallies, we're going to see gold sell down as well, which means if these are already going down when gold is actually going sideways, when gold falls, these are probably going to pick up speed even more. Typically, the ones that are underperforming are the ones that are going to drop even faster when real selling pressure actually hits. So I think there's going to be an amazing opportunity once everything is flushed out, if we do get this major correction potentially next year. And I think miners and metals will be very fairly valued, along with stocks as well. But I think they're going to have a huge move going forward. And I think uranium stocks are also going to have massive potential, simply because of a climate change. There's so many ways that uranium can be used with these small little facilities that can, you know, produce so much energy in a very controlled, low risk way. I think uranium is going to come back online, and these little modular systems are going to start powering states. And I think maybe that's why we're seeing uranium stocks come to life, because we're starting to see this, you know, people want to see the climate net zero, pollution, more or less.
Yeah.
You know, by 2030 or 2035. So I think this is going to start to play into the uranium space. And I think the early money is seeing the potential in uranium power.
Okay, finally, before we close off, I want to talk a little bit about your strategies around asset revesting. You have a book called Asset Revesting. For those of us who may not have seen your work, tell us a little bit about that philosophy and how it works.
This is very important. Think about what he's saying.
Yeah, so asset revesting, that's a term that Ashley and I coined simply because it's kind of between the current trading strategies that everybody uses. To me, there's two risky strategies that almost everyone does in the market. First one is active trading. There are numerous studies across North America, Taiwan, Japan, showing that active traders who actively trade for 300 days or more lose money. 97% of them lose money. So active trading, just because you trade more doesn't mean you're going to make more. Emotions play a huge part of it. People don't understand how to manage positions. So that's the one thing that a lot of people do. The other high risk strategy is the buy and hold. If you've been buying and holding stocks, then you are in serious pain because of falling stock and bond prices. And so asset investing is kind of right in the middle. We do just enough trades. We only focus on assets that are going up. We step to the sidelines and just collect interest on a daily basis when we're not in a position. And it's all about just taking control of our capital and finding assets going up and putting our money in there, reinvesting our capital into, the dollar or, bonds when they turn up, or the equities markets. And we move into one asset at a time. There's usually one asset class performing well, and we want to move into the one that has got the best uptrend. And when it shows signs of weakness, we move to another asset that's on I call it an asset hierarchy. So we've got volatile assets at the top of our hierarchy, like the stock market, then bonds, then the dollar, and then like a cash type of position. And so as the markets get more volatile and unstable, we move down the list to slower, more conservative assets, which is why I kind of mentioned earlier, I love the dollar index because it's slow, it trends nicely, and it can go the opposite direction of the stock market, giving us a way to make money while the markets are falling apart.
And this book's philosophies, are they aligned with your own trading philosophies for the technical traders?
It is, yeah. That's all I focus on is asset investing strategy. That's what I share, what I kind of teach, and all the trades that we put on are all based on just finding assets going up, stepping aside when they're not. And yeah, it's the nice thing about it is our accounts are usually near all-time highs because we get out of a trade as soon as it starts to flatline or roll over, and then we wait for a new one. We don't ride things down. And the 2022 was nice. Our account just slowly kept hitting new all-time highs while the stock market fell 25%. And it's a very slow strategy. There's like 5 to 12 trades a year, but that's all that's needed. You don't need to trade more. There's a certain amount of waves that kind of roll through the market every year, and we just look for these waves. I think the best analogy is I'm a surfer, kiteboarder, and if you think about walking down a beach or on an ocean, you see surfers out past the break, right? They're floating out there waiting for a nice clean set of waves. When you see a nice move coming, you can see it, it has momentum. And then once you're riding it, you also know when that momentum is starting to stall, when you got to carve off the wave and you're like, this trend is coming to an end. Let's wait for something fresh. So I wait for sets of waves to come through the market. We hop on the asset that has the best setup on our asset hierarchy, and then we ride it. And then we just scale out of that position as it's maturing. And then we rotate into a new asset when another wave comes through. So that's kind of how I look at it, how I navigate the markets.
Okay. Well, excellent. And riding the markets. Well, I'm just visualizing you with a surfboard and a chart. It's just something we don't see very often, but maybe in the next interview, bring your surfboard and bring your charts.
Right.
Chris, that was a great interview. Where can we learn more about your work?
Sure. They can go to thetechnicaltraders.com. And from there, I've got a blog with lots of content, and they can send me an email and they can learn more about the asset investing strategy there.
How have your strategies changed over time?
I mean, the whole asset strategy for CGS has always been around the indexes and bonds. The only thing that's really kind of evolved over time is more so adjusting the strategy as volatility changes. We've added in the dollar, which gives us some opportunity to pull more money out of the markets. And there's some nice ETFs that allow you to collect interest sitting on the sidelines, like BIL. Other than that, I mean, it really just kind of lives and breathes. So targets and stops adjust with the markets. And we really just focus if the money is flowing into a particular asset, we just focus on those assets, which is equities, bonds, currency. because they're the most liquid, they're the most stable. You can apply it to sectors as well, which we do, but I find it's easier to identify money flowing in and out of the overall broad market, because that is like the whole school of fish, the masses moving in the same direction. It's much easier to time and trade the markets, the indexes itself, versus little pockets that are popping and dropping.
Okay, excellent. Well, make sure to follow Chris in the link down below. Thank you very much for your time today. Speak again next time.
Thanks, David. Take care.
Thank you for watching. Don't forget to like.
All righty. Hopefully everybody you gleaned a little extra information from here. To tie everything in, right? If we're just here as a group entering trades every week, we don't have goals, we don't have vision, we don't have a strategy, eventually we're going to lose. Time in the market isn't your friend. That's not a flex. That's not what benefits us. A system of trading that allows you to take advantage of the system and sit on the sideline when the system isn't working, that's what's going to create wealth, in the long term, right? If you don't have a strategy, if you don't have goals, then you're just going to make money and give money back. Make money, give money back. You're not going to have a system that will allow you to grow money, right? So if y'all trade, along the same lines as I do as a swing trader, I'm looking for specific moves, right? I want to enter a trade. I want to ride it to a point. Then I want to take the opposite end. Either I'm buying to sell or I'm selling to buy. But when the trade is over, I look for the new move, right? It's not I'm trading because it's today and I'm looking for a setup. That's not how it is. Once the trade gives me my entry, I enter the trade. Here recently, the entry is not a single entry. I'm going to walk into that trade, and then I'm going to take the trade to a destination, and we can talk about it from this standpoint, right? Of this GA trade. So on this GA trade, we got into the trade when it turned around, right? Somewhere around here was the first position. When it pulled back, another position. When it pulled back, a third position, right? If you got in here, then you could have entered another position, which it will eventually put you in drawdown or taking you out if you had already moved your stop loss according to these swing lows. So if you are a person who takes these trade opportunities and you're managing your trade on this 4-hour time frame, you would have closed out when this 4-hour pullback went below this swing low, right? And all this is a pullback on a higher time frame, which might be the 6-hour, it might be the daily, and in this case, it was probably maybe the 6 or 8 hour, because the daily hasn't even pulled back properly, at this point. So we can see the 6-hour, we got a pullback here. This would have been a good pullback on the 6-hour, and we haven't violated it yet, but we will. You just have to understand that on the higher time frames, the trades will pull back the same way they do on a lower time frame. So all you have to do is you could fib this move on the daily and see where it's pulling back to. It's probably going to pull right around to the same level. And if you look, I moved this out of the way. Here's a shoulder. Here's a head. It's probably going to come give us another shoulder before it pushes up to our area of interest. If you are taking this trade and you're trading it, you would have just needed those 2 entries last week, and you would have made, I don't know, 230 pips on the first one and maybe 110 on the second one. So maybe you've made, let's call it 350 pips off of two positions, and you could have closed out on Friday because you know it's going to pull back. That pockets your money, right? That's part of the strategy. Next week, you're going to wait for it to pull down, or maybe you'll sell it to buy it back up. And you're in the trade. You're just holding those positions until the end of the week. Maybe it will be up in this area, in which case you don't have to get out of your position because you're waiting for it to turn around at this point where you can start adding your sell positions, because the real move is the sell move. But your strategy, you have to be lockstep with your strategy. You have to have a good understanding of what you are trying to do, right? You're pocketing cash along with your strategy. It can't be, hey, I'm just looking for a trade setup today, and let me pocket as much money as I can today. It can be that, but the chances of you getting caught up into a buzzsaw at some point, the chances are higher, because active traders don't generally win money. The more time you spend in the market, the more risk that you accept, the more risk that you expose yourself to. So, you know, I can't tell you what system is correct for you, but what I hope everybody understands is trading is best when it revolves around a system, right? And the system is what we utilize to make money. So if you haven't found a system, I would implore you to find a system. It's not just, it shouldn't just be about coming and finding trades, placing trades, because that's how you get, that's how people over time get ransacked. We have any questions?
Well, I got a comment that it's fun to sit back and listen to people say, you know, nobody really knows what. Yeah, you do know.
Exactly.
It's telling you everything. Like, and when I hear people, I understand what they mean when they say that, but you do really know. It's telling you when it's breaking that high that it's got to pull back. It's telling you.
Exactly.
It's a beautiful thing, man.
And there's always a higher time frame chart. You know, I mean, to me, it's elementary. You look at the higher time frame will tell you what's happening next. We're just reading a book. That's it. The next move in the market is forecasted by whatever book you're reading. Bearish order block, the market goes up, takes the liquidity. Now it's going to push down. This happens all the time. So as a trader, all we're doing is reading the tea leaves, and we're getting in on the right side of the move. And I'm not saying I guarantee you this is going to happen. No, but whenever something goes sideways, if it does not respect my personal analysis, then I have to sit my butt on the sideline. I can't trade because of what I think. I think about it, and as long as the market goes along with my thought process, then I can participate in the trade. The minute that it breaks my thought process, I have to sit down and either reassess the market or find a setup that agrees with the analysis that I did on it. Are y'all tracking? Is anybody confused over things that we discussed today? Everybody good?
Good.
Okay, does anybody want to break down a pair for the coming week?
Come on,
What y'all trade?
who that is?
Did any of y'all
Why?
have success last week?
Come on, who that?
y'all
Had success in holding my trades.
Well, I mean, so this is what I would say for y'all stingy people who don't want to share.
I just shared something.
Well, I understand, Elfie, and
Elfie, you a boss now.
yeah,
We ain't talking about you no more.
Yeah.
yeah, but this is what I would say. The people who are finding success, they depended on somebody else sharing, right?
Like,
So if you found some success, if something has been working for you, I would appreciate if you would share it. Other people in the group would probably appreciate you for sharing it as well. The reason why I pulled back from sharing is because I feel like people were depending on what I'm sharing to take their trades. I don't have a problem with marking up a chart or telling you what I'm looking for. Does anybody want to share? And if not, you know, it is what it is. I mean, we don't have to share, but the order block information is out there.
and we're building a community. So this is what it looks like. Eventually, when you're back, I don't know what number you have to hit to get excited. Whenever you're ready, we're gonna be here. Your voice needs to be heard. So that's why we're doing this. We've graduated this part of it. It's time for other people to do this part now. We've done this, right? We can drop a dime on a chart at any time. So, and we'll back up anybody. So that's what we do.
And a lot of the reason why I don't share, because I'll be confused. So I don't want to trip anybody else up, but I would say trading GN, I got in at a good point, but my issue I'm still having is where do I get out? So I was texting you, Todd. I'm like, okay, how long do we ride this way, basically? And you're able to tell me, but that's where a lot of my confusion is. Like, okay, I'll get in, but then I really don't know how long to hold.
Yeah, I mean, that's because you've been trading for 2 weeks. The direction of the market and where you're taking it to is based on the higher time frame. Let's talk about GN since you brought GN up, right? So if we're analyzing GN, we know that the market pushed from here. It pushed up, it broke this high, right? It consolidated a little, it pushed higher. When this market came back and broke these lows up here, it let you know that the market was going lower. It just kept falling. It broke these lows. It broke these lows. It broke these swing lows. And it came all the way down to this area and pushed back up, right? When it pushed back up, it broke these highs, which tells us now that the market should go higher. Well, where is it going? That's when you can fib. You can fib from these highs to this low. And because we know we should go lower here since we broke this, we expect the market to push back up to the golden zone or the 78. I would expect the market to come somewhere in this area, turn around, and sell off. So when you text me, you were texting me because this started pulling back. What's going to happen is this market buys up, breaks these highs, which is what we call a chalk, a change of character on this daily chart. Breaking these highs, it needs to pull back. You need to fib from where it came from the low to the break of these highs. It should pull back 61, 78%. Then it should push further up. Does that make sense to you?
It makes sense, but I'm like, at what point in the pullback is it a sign to get out? Or does it pull back
Oh,
and just go up, or will it just
well,
pass the
listen to what
61 and
I'm
keep
telling you,
going?
folks. Where did you get in the trade?
Um,
Where did
let
you
me
get
check.
in the trade?
Hold on, let me see. I got in at Hmm. I got in at 2.03464.
So you got it.
What?
You got it down here somewhere.
Yes.
That's a
Yeah.
good.
Girlfriend.
I took a second.
It's a great entry. Now,
I
Yes.
took a second one at 2.04639.
okay, so
So
Oh,
that one is bad. Like that one
okay,
is
so
negative right now.
so here's what I can't manage anybody's trade. As a trader, once you understand, hey, we broke these highs, we're probably going to pull back. You could have taken profit on this trade, or you could have sold this move. If you sell this move, then you're not going to lose any money from what you've made coming up. But some people have a problem going both ways. They're not bisexual on these charts. You either have to be able to trade both ways, or you need to be able to take profit on this bad position, or it's not a bad position. It's just, it's a position that's in the middle of the range. So you have to be able to either take profit on this one or sell this move down and expect for it to turn around in this area. Now, the beautiful thing about trading is we all have expectations. Sometimes our expectations get ran through by the market. So we have to expect, but we have to pay attention. So if it's me and I'm selling this move, I'm putting alerts down here because I don't want to be asleep on Tuesday night and thinking that this trade is going to turn around and just keep selling. Does everybody understand that? Do you understand that, Fo?
Yeah, that's what I'm asking. I'm like, at which point do you know that
Hey,
it's gonna keep selling?
well, at the point that it breaks this 78 for me.
Okay.
But until it breaks the 78, it's just a healthy pullback.
Okay.
And I would be
I
looking,
have a tip for that as well.
hold on,
If you okay, yeah, sure.
hold on. At this point down here, I would be looking to add when it turns around and pushes up. I would be looking to get in again. Just like you got that great position down here, I would be looking to get in again once it comes down here. Because once you get these positions, they shouldn't go negative on you. They shouldn't go
hey,
in the red.
No, it's not. So the pullback,
Okay.
I'm like breaking even. On my second position, I'm down, but they keep fluctuating. So that's how I just been
But
holding.
as it pushes further down, you're going to eventually go in the red because of this position up here. But as long as you didn't over leverage, hopefully your account can hold up to the pullback. Hey TT, what were you gonna say?
I was gonna say, she was wondering like how she might see when it's gonna turn around back to the upside. You can watch for those internal breaks on the lower time frame, like starting like on the 1 hour and then the 4 hour. So you can, when you see when you scale in on the smaller time frame, if you can go to the 4 hour right now, I'll show you kind of like what it looks like. It's like zigzag,
I don't think she's at this level yet, but yeah.
Yeah, I'm
Oh,
like,
oh,
you lost me.
oh, okay.
oh, that's right. That's right.
When you're trading for 2 weeks, man, like when you
Oh,
get to
okay.
flipping them in them time frames,
Mhm.
people get lost.
Okay. Okay.
She said 2043.
That was my second entry.
2046 or 2043.
The first entry was 203464.
But the second entry was 2046,
Yes.
like somewhere around here. Probably on this side right here.
I personally, it's not the greatest because that bearish order block It is, it's probably going to go to the 78. Now think about this. Now we're saying that low is the low, right? If it goes lower than that, then it's going to be a breaker block. It's going to give you that next low just to sweep that, right? And then it's going to drop you into the buy position. These are just the best. That's the only thing that can happen from here. And then that's why I say it sucks to get stopped out. It sucks to be in drawdown, but your analysis is correct. You have to come out of this with this buy position at its lowest point. And you always go to the liquidity points. It's at the bottom. Don't do nothing. If we would have been talking to you, you wouldn't have took that position, because we would have been telling you 78. You have the catbird position. You want to wait, let it do what it has to do. You're not losing anything. And then you get another position. Now you're losing something. So, but that's okay, because you caught a catbird position. You only been trading for a couple weeks.
And this position, when you got into it, it went in profit. The problem is you didn't recognize, or you didn't understand. Once we broke this high, we pulling back, right? Or once we broke these highs, we pulling back. And if you would have known that, you could have put a fib from this bottom to this top and seeing, okay, we're going to pull back to about this area. So I can take profit on this one and wait until it pulls down to this, and I can buy it again. Now, when I buy it this time, this position and your original position are both going to be in profit the entire trip up.
Okay.
And don't be afraid to talk about it, because that's what's it's gonna streamline everything. It sounds like, oh, I don't know what I'm talking about, to I know everything. Elfie knows everything.
I wish.
Yeah. She sent her homeboy Sam Bankman-Fried to jail though, but she didn't go to jail with him.
Stop talking about me.
Thank you.
You're welcome. All right, y'all. Hey, the Texas OU game is on, so I'm gonna go watch the game. Man. Y'all ain't got nothing to share. Y'all don't want to break down the charts.
Go Bucks.
Hey,
Go Bucks. Yeah, go Tampa Bay Bucks. Yeah.
Don't do it.
Go Tampa Bay. Yeah. Nobody care about no Buckeyes, girl.
Hey, it's time to get off this. Back to the game.
That is hilarious.
all right, y'all. Awesome meeting.
All right, y'all. Y'all have a good one.
Gold for the
you.
buy. Hey.
Hey,
You
thank
ain't lying.
you.
Gold should be a good buy next week.
Hey.
The indices too.
Hey.
Great. Exactly.
Thank you, bye.